and welcome to the Mutual Fund Guide. It's all about your funds and your returns. I'm Vandita Shukla. Joining me on the show today is Abhinav Angirish, founder at InvestOnline.in. Welcome to the show, Abhinav.
Thank you, Vandita.
Thank you so much for joining us today. But Abhinav and our viewers, before we begin the show, as always, let's take a look at the winners and losers of today. Every day, as promised, we bring you the top funds in various categories like market cap and thematic category. While it is important to stay invested for a reasonable period of time to make money, it is also extremely important to track the fund performances. They're now flashing on your screen. Alright, let's start with our first email now. That's coming from Anil Kumar from New Delhi. He has emailed up his query and he's 59 years old. He wants to invest 1 crore rupees in MFs from his Provident Fund. Now what he actually says is that after 3 years, he will need annual returns of 8 lakh rupees. He is a moderate risk taker and he's expecting a compounded annual growth rate of around 12 to 13%. He needs some suitable investment plans and funds for that. And should he not withdraw this Provident Fund, the amount that he's planning to withdraw from Provident Fund and put in MFs, should he not do that so that the interest can continue to accrue, although it will be taxable? What are you recommending him?
Okay, so first things first, yes, his interest in the PF will get taxable post-retirement. So ideally makes sense that he exits the Provident Fund investment. Besides, it would be prudent for him to actually have a mix of equity and debt in the portfolio. You could choose multiple ways to do that. You also need to understand that if he invests into equity, any amount beyond 100,000 of income later as a long-term gain, if he exits, will attract 10% long-term gains tax. On debt, similarly, he'll have a long-term gain tax of 20% post-indexation, which happens after 3 years. So after 3 years, whatever the indexation value of your investment is, accounting for that, less the actual gain, and that's the tax you have to pay, which is at 20%. Both are much better than if you are in the 30% tax bracket and so on, so that they become much better as an investment category than paying pure interest. Having said that, since he is looking at withdrawing about 8 lakhs on a current corpus of 1 crore, which is about 8% at the moment, if he invests for 3 years and even if he generates 7-8% on his monies, it will turn out to be about 1 crore 30 lakhs at the end of 3 years. Then generating 8 lakhs on that should be as good as just about 6% kind of a yield, which is fairly possible. So I would say you break up your portfolio into a large cap fund, have a hybrid as well. You could also choose 2 debt schemes. So I would recommend him to have a Mirae Asset large cap fund. In the large cap equity category, have the Kotak Dynamic Bond Fund, SBI Equity Hybrid for the balanced and the equity and debt mix, and you have a pure debt fund, which is an accrual fund on the ICICI mutual fund side, which is ICICI Prudential Regular Savings Fund. So if he breaks up the portfolio in this manner, I think it'll be pretty easy for him to generate the 8 lakhs after 3 years when he wants to withdraw.
And his second question on PFs, like, do you think he should have some money left in his PFs as well?
It may not help him because it will be taxable to him. Assuming that, let's assume that he continues and he sticks with his investment of PF, his interest will account for the highest tax bracket, I mean, at least at 30% at the moment. So net return doesn't become anything. So post-retirement, it will be taxable to him. So might as well withdraw and make a portfolio in this manner.
Right, but he should still have some amount in PF for capital protection. Like if he's building a portfolio.
So you are anyway investing into debt funds, right? So if they are good accrual funds with good portfolios, the ones at least which I have recommended, I don't see a reason why they should not make better returns. Also,
but what about the capital protection part?
So capital protection, see, more you go into interest categories and naturally your returns will keep on shrinking, right? Also, the good thing about funds is that being NAV based kind of investments, market related funds, your gains are taxable only when you tend to exit them, right? In case of interest bearing instruments like a Provident Fund or a fixed deposit and so on, your interest is taxable to you and accrued to you on an annual basis whether you take it or not. So even if assuming you are an accumulative strategy, end of March you will have to account for it and pay tax on it anyway. right? So you might as well be into these instruments like we recommended. Would probably be prudent for him from tax point of view.
Right. All right. So that's a suggestion for you. Large cap, hybrid fund and 2 debt schemes. That's what our expert is recommending, and you can always write back to us if you have any further follow-up questions on that. All the very best with your investments. Now let's move on to our next caller who's on the line from Anand. Molesh. Hello and very good afternoon, Molesh. What's your question?
Good afternoon.
Please go ahead.
I've just recently retired and I got a 50 lakh in my PF money, which I wish to withdraw. And current my net of tax return is about 6.08 in the PF. So is it what I've been told that you put this 50 lakh into a say liquid fund and then do a STP to 2-3 funds. SDFC Prudence, Reliance Stock Limited, ICICI Blue Chip.
Okay.
So is this a correct strategy? That is what my question number 1 is. And whether STP would attract short-term capital gain. And would this strategy give me more than say 12% return?
Okay.
And and fund selection is okay or not?
Yes, I understand. But this strategy that your advisor has given you is he's keeping asset allocation point of view, and he has started up with that STP because there are different kinds of STP. I think he's gone with the third option where he's moving his from liquid funds, he's initiating an STP to various equity oriented funds. But let's hear from our expert, Molesh. Maybe know your age, please. We know that you're retired, but if you could just mention on that, like. Molesh, how old are you? If you
I'm 61. I'm 61
okay.
Currently.
All right, Molesh. Thank you very much. What do you suggest?
Okay, so STP as a strategy is common. There's only one specific strategy you have is to invest into liquid and eventually move to equity oriented schemes. STP does nothing. Works like an SIP, wherein you're averaging your purchases on a month-to-month or a quarter-on-quarter basis.
Right.
Right. So you keep on accumulating more and more units depending on the market conditions and not trying to time the market. It's a good strategy.
Okay.
Coming to his question, whether he should be doing it or not, and if they're taxable to him. So when you're investing in the liquid schemes, considering that this money will be eventually going to equities, choose a dividend reinvestment option rather than choosing the growth option. Right. Though dividend does account for dividend distribution tax, which is paid before the investor gets it, but investor gets it in hand net of taxes. And anyway, his end goal is to be into equities. So he rather chooses that, and he will most probably will not be taxed at all because the dividends take care of the gains made in the liquid funds. Yes, he should invest these monies into equity. His question on the HDFC Prudence, this scheme does not exist anymore. HDFC Prudence got merged last year.
Balanced.
Yes, so it's become a balanced advantage fund right now after recategorization. So HDFC Prudence, HDFC Growth and Balance are now the same scheme. It works similar to how Prudence worked then. So yes, he could invest into that. However, I would recommend him to change the strategy and be into 3 different kind of funds. Choose a large cap fund like a Reliance large cap instead of the top 200 which he chose. I prefer the large cap fund comparatively. I would say look at the slightly aggressive one, Canada, Rebecca, emerging equities, and go on the multi-cap strategy of HDFC equity.
Right. So you think the strategy is fine, it's just that
Yes.
the fund selection is not
I would say fund
great.
selection could change a bit and deferred if
And
we have
instead
to
of
allocate.
growth, they can go for dividend reinvestment.
See, in the liquid side, stay in dividend reinvestment.
Okay.
I don't think he's looking at withdrawing the money at the moment. So in the equity side, stay in growth. Let the units keep accumulating since it doesn't require the dividend from those schemes. So that would be a rather better strategy than just being.
So Abhinav, just a word on that. So you think that, just for the information of our viewers today, there are 3 kinds of STP, right? One is fixed, where a person has that flexibility, like there's a fixed amount, irrespective of the NAV falling or rising. You can have a fixed STP set. Then there's a variable STP where when the NAVs are falling, you can invest more money and vice versa. And then the third is what the advisor did for him, right? Where he has taken, where he has kept this asset allocation in mind, as in it's going from liquid funds to equity funds.
Right.
Right. So when the market corrects, he can stay with the liquid funds and
So that's also variable SIP itself.
Exactly.
So STP by default is from A scheme to B scheme.
Right.
A scheme typically being a liquid or a short-term, very ultra short-term debt funds because the eventual goal is to move to equities.
Absolutely.
So STP stays there, yes. What you're suggesting are the sub options where you're saying instead of just having, investing a fixed amount, I could go into the variable STP mode, yes, depending on the market conditions. You can choose that option too. Third category is the asset allocation. But I'm saying broadly, the
This is a part of
investment, the
variable.
liquid to STP is that stays anyway. So that does not really change.
And he should be very careful of the cost and transaction, cost and tax implications as well, right? Because when you move from equity to, because it's treated as a sales transaction according to Income Tax Act. So
But you are not selling equity. You are selling your liquid fund investments. So liquid fund, if they are anyways into dividend reinvestment, your NAV will drop every time a dividend gets reinvested. Typically, it's a weekly or a daily kind of a reinvestment.
Right.
So you are not liable to pay any short-term gains.
Okay.
Right, because your NAV grows, you get a dividend, NAV comes back down. So when you are exiting the scheme or whenever you are selling, practically you're not making any gain. That's why I'm saying it's better for him to be into dividend reinvestment than being in growth.
Exactly.
Because growth will attract short-term gains to him every time he exits. The NAV will keep rising on a week-to-week basis.
Yes, so
right?
that
So
way he
whenever
can be
exits.
more cognizant of the cost and tax implications as
absolutely.
well. So are you clear with the answer, Molesh?
Yeah, no, I just want I'll repeat what I understood. That as far as the liquid fund is concerned, I should invest in a dividend reinvest option.
Yes.
And as far as the funds are concerned, it should be growth.
Yes.
Absolutely.
Oh, very kind of you.
And
Thanks
the
a lot.
fund selection is what our expert have changed. So he just recommended the funds, and I think they were on your screen. I really hope that you've noted those as well.
No, my TV is not working. I'll just repeat it. SDFC Balance Advantage, he said. Reliance Top 200 and Canada Rebeco.
No. So I didn't recommend you to be into Balance Advantage Fund. I'm just explaining that the scheme is Balance Advantage now because you asked for a prudence option. I'm saying instead of Reliance Top 200, choose Reliance Large Cap. You can, the other scheme to choose is Canada Rebeco Emerging Equities Fund. And the third scheme I recommended to you was in the multi-cap category of HDFC, which is HDFC Equity Fund.
Equity fund.
Okay.
All right, Molesh.
And short-term capital gain won't attract, no?
Sorry, I didn't get that.
Could you repeat that for us, Molesh?
Short-term capital gain, because the phone got disconnected, I didn't get whether short-term capital gain will be attracted or not when I move from liquid to growth.
Okay, so
no, you will not. So short-term gains, Malesh ji, will come into play only when you exit your equity schemes. It doesn't look like you're going to exit your equity schemes at the moment. So capital gains comes into play only when you're exiting. But because the liquid is into dividend category and your NAV will keep falling every time there's an exit. So comparatively, you will have negligible gains from your liquid schemes as well.
Yeah, that's very nice of you. Thank you.
Pleasure.
BTVI.
yes. All the very best with your investments, Molesh. Let's move on to our next email now. That's coming from Raghav. He's emailed up his query. He's investing via SIP, 2,000 rupees in each Kotak Standard Multicap, HDFC Small Cap, and ICICI Prudential Blue Chip. Now, what he says is that he wishes to accumulate 1 crore in 10 years. He wants us to review his portfolio and advise an investment strategy for this goal.
Wow. Okay. So if you're investing 6,000 rupees a month, which is 72,000 rupees a year, to get a crore in 10 years, you're practically expecting 40-45% annualized return, which I don't think is going to happen. It looks
It's not that
unachievable.
realistic for sure.
So no, you need to get realistic on your numbers.
Yes.
You're looking at accumulating a crore. I would say, firstly, when we recommend, we always say, assume you will make 12% on your equity investments over a period of 7 to 10, 15 years. If I consider that, he needs to up his SIP amount considerably. So he needs to go from 6,000 to at least about 42, 43,000. Only then is when the 12% returns will generate a crore over a period of 10 years. So nevertheless, it's a huge jump, almost 8 times from what he's investing at the moment. So in that case, what I would recommend is, if you can't do it immediately, do it gradually. But focus on increasing your SIP amount, only then it's going to work. Your schemes are fine. All the 3 schemes are good to invest. There's no problem with the schemes.
Okay.
But you will need to increase your SIP as soon as possible, or if not, at least periodically, as in when you start getting surpluses. or when your salary or income rises. If you get bonuses, you can add to the same schemes as well. A big myth, misconception people really have is that when I have an SIP, I can only use it for my SIP investments. But the folio is same. So you can, if you get a certain surplus in hand, you can also add to the existing folio as well.
Absolutely. So all the very best with your investments, just that you need to increase your SIPs to really reach the kind of goal that you're looking at. 1 crore is a big amount, so you need to plan your investments in such a way. All the very best with your investments. Let's move on to our next caller now, who's on the line from Pune, Sachin Gupta. Hello and very good afternoon, Mr. Gupta. What's your question?
I have been investing in some SIPs of mutual funds.
Okay.
And I am investing around 65,000 per month.
Okay.
And I have shared my list of the mutual funds. I would like to understand that whether I would be able to achieve my goal of 7 crore in 15 years.
Okay, sure.
Or any change is required in my mutual fund portfolio.
And if you could just tell us your age once again. I mean,
I'm 41.
You're 41. Okay. Thank you, Sachin. What are you recommending, Sachin?
Okay. Firstly, he has too many schemes. I'll come to that later in the second part. First, and the most important part, his target of 7 crores in 15 years, the period is great. I mean, it's a good time that you can accumulate as much as you can and you can get it. But the corpus that he requires substantial increase in investment, just like our previous emailer. So, by the same logic of calculating 12% returns on the monies, his 65,000 amount is way less. He needs to up this to at least about 1,40,000, 1,50,000 a month. Of course, 12% is a very achievable number. It could go higher, but it's safe to focus on that specific number. Also, since he has that kind of a tenure in mind, why does he need to be in so many large caps? He could probably drop 2 of his large caps, probably drop Axis Blue Chip and Reliance large cap in this situation. He's also just 41 years of age. He has time on his side. Add a small cap because they are more aggressive and you can generate dramatic alphas in these kind of investments. So look at the HDFC small cap instead of these 2 investments. Also, just like the previous caller we discussed, try and increase gradually if you can't do it immediately. But you will need to increase the amount of your SIP investments.
Right. So, Sachin, are you clear with the answer? So, what our expert is telling is currently you're investing 65,000. That is definitely not enough. You need to, increase it to at least 1,40,000 a month or 1,45,000 a month to achieve that goal. And secondly, there are too many funds. Having so many funds will not make much of sense. Have lesser funds, it's easily manageable, and you can reach your targets earlier. Then you can think of moving out from Axis Blue Chip and Reliance Large Cap. Are you clear with the answer, Sachin?
Yes. Thanks.
All right. All the very best with your investment, Sachin. We really hope that you get over there. But now, very lastly, before we end this show, I would like to ask you a very basic question that, what are you advising your clients in this market scenario related to, anything related to debt funds? What are the kind of, because we have seen the bond yields are falling, there's so much happening in the debt market. What do you think a debt investor should be doing?
So, I think it's a good time to invest in debt. Couple of reasons. Yes, like you're saying, the interest rate cycle is moving. That's why it's good to be in dynamic bond funds, like we even discussed with one of the callers. It's a good time to be in these kind of investments. 2 is on the investors who are looking at more accrual and more stable returns. Credit risk theme is becoming very attractive. After the turmoil in the NBFC space, which we saw last year, and corrections in the corporate bonds and these NBFC bonds per se, the portfolios have pruned dramatically. So when you see that, I mean, today there are many funds available which are purely AAA rated and so on.
Thank you, Abhinav, for joining us today, helping our viewers, addressing their concerns. And viewers, that's all the time that we have on this edition of the Mutual Fund Guide. Thanks for watching us today. More news and updates continue on the other side.